Everyone's jumping into AI stocks like there's no tomorrow, convinced they've found the next sure thing since the internet boom. But here's what nobody wants to talk about. Something scary is happening right under our noses. Don't get me wrong, AI is absolutely going to change everything, but there's a massive disconnect between what these companies are worth today and what they actually delivering. This isn't about technology breaking down. This is about reality finally showing up to the party. And trust me, when hype meets hard numbers, things get ugly fast. Let me paint you a picture from the 1840s in Britain. The whole country went crazy for railways. Rich people, regular workers, everyone was throwing their money at railway stocks. And sure, trains were genuinely game-changing. They completely revolutionized how people moved around. But here's the kicker, the stock prices were absolutely insane. We're talking companies valued at 50, 60, even 100 times what they were actually making. People weren't buying based on real profits. They were buying dreams, imagining railways connecting every single town, unlimited demand, zero competition. Then the wake-up call hit. By 1850, most of these railway companies went bust, the survivors. They spent the next several decades drowning in debt from those crazy boom years. The trains worked out great, the investors? Not so much. Jump ahead to March 2000. The internet bubble is about to explode. You've got companies making $0 valued at billions. Remember Pets.com, Webvan, Cosmo? They swore they'd revolutionize everything from pet food to groceries. Look, the internet absolutely changed the world. But thinking every single internet startup would dominate the market, that getting customers was free, that profits could wait forever, that thinking destroyed fortunes. When everything crashed, $5 trillion vanished into thin air. The Nasdaq needed 15 years just to get back to where it was. Once again, the technology won. The investors lost big time. Now here we are in early 2026, watching the exact same movie play out with artificial intelligence. The details are different. They always are, but the warning signs are flashing bright red. Let's talk numbers. Financial experts are showing us that AI companies right now are valued at 20 to 50 times what they make in a year. That's just the average. Some are way worse. OpenAI hit a $500 billion valuation at the end of 2025 while bringing in only about $12 billion a year. Do the math? That's roughly 70 times what they earn. Anthropic reached $183 billion with multiples above 40. Perplexity, this smaller AI search company, is sitting at 90 times its revenue. And get this, none of these companies are even making money yet. Experts predict OpenAI won't turn a profit until at least 2030, and they might need over $200 billion just to keep the lights on. They re-spending about $60 billion a year on cloud computing alone, way more than they remaking. Meanwhile, regular software companies, they're valued at about 6 to 7 times their revenue. So yeah, AI companies are getting a huge premium. Should AI be valued higher than normal companies? Probably, but 7 to 10 times higher than proven, profitable businesses? That's where things get sketchy, but individual companies are just the beginning. Let's zoom out and look at the massive infrastructure build-out happening right now. The 5 tech giants, Amazon, Microsoft, Google, Meta, and Oracle are planning to spend over $600 billion on infrastructure in 2026 alone. That's 36% more than 2025, about 3/4 of that money. Roughly $450 billion is going straight into AI stuff. We're talking GPUs, massive data centers, networking gear, industrial cooling systems. Goldman Sachs predicts these companies will drop $1.15 trillion total from 2025 to 2027. That's more than double what they spent in the previous 3 years. Here's where it gets wild. These tech companies are now spending between 45% and 57% of everything they make on this infrastructure. That's the kind of spending you see from utility companies or factories, not software companies. And because it's so expensive, they're changing how they pay for it all. In 2025, big tech borrowed $108 billion to fund this expansion. Analysts think the tech industry might need to borrow $1.5 trillion in the coming years. This is completely new territory for tech. Historically, tech companies funded their growth with cash they made or by selling stock. Borrowing this much money is different and risky. The bet everyone's making is simple. A. I will make tons of money. Companies will pay top dollar for AI tools. Workers will become way more productive. Brand new markets will open up. All this infrastructure will pay for itself many times over. But let's actually check if that's happening, because this is where things start falling apart. On paper, AI adoption looks amazing. A PwC survey found 79% of companies using AI somehow. But using AI and making money from it are completely different things. When you ask executives about real results, the answers get fuzzy fast. A late 2025 survey found nearly 90% of executives said AI hadn't improved productivity at all over 3 years. Read that again. 90% saw zero productivity boost after 3 years of investing in AI. Some companies report gains, sure, but they're usually pretty small. A few percentage points saved here, sometimes saved there. Penn Wharton researchers predict AI will boost productivity growth by less than 0.1% in 2025, maybe hitting 0.2% in the early 2030s before fading away. That's something, but it's definitely not the revolution that justifies these crazy valuations. Software development is a perfect example. Early reports from companies selling AI coding tools claim 20 to 55% productivity boosts. Great headlines. But independent research? Totally different story. A nonprofit research organization tested this properly and found that while experienced programmers thought AI made them 20% faster, actual testing showed they were 19% slower. Data from GetClear shows engineers writing about 10% more code since 2022, probably because of AI help, but that same data shows code quality is dropping fast. More code doesn't mean better code. A Stanford study from late 2025 discovered that jobs for entry-level programmers aged 22 to 25 dropped nearly 20% between 2022 and 2025. AI is definitely affecting jobs. But it's not clear if companies are actually getting their money's worth yet. Meanwhile, the costs keep piling up. OpenAI spends over $5 billion a year on cloud infrastructure. That's more than the $4.9 billion they're making. The basic economics, what it costs to deliver the service, what customers pay, still do on work for many AI products. Now let's talk about the third major red flag, energy and infrastructure problems. AI data centers eat electricity like crazy. We're not talking small increases, we're talking about the power consumption of entire cities. Some proposed facilities want more than 5 gigawatts of power, which is more than whole metro areas use. PJM interconnection. America's biggest grid operator, serving over 65 million people across 13 states, says they'll be 6 gigawatts short of what they need in 2027. Joe Bowering, president of Monitoring Analytics, said in early 2026 that the power grid is at crisis level. His exact words, crisis stage. The problem isn't just having enough power total, it's about timing. You can build an AI data center in about 3 years. Building a big power plant or transmission lines? That takes 5 to 7 years. This timing mismatch is creating bottlenecks that could physically stop AI expansion no matter how much money people want to spend. And there's politics getting involved now. Home electricity bills went up 5% in 2025 and are expected to jump another 4% in 2026. Monitoring Analytics says $23 billion in increased costs come from data centers, costs that get passed on to regular people. People are angry, and it's happening on both sides of politics. Senator Bernie Sanders wants to pause all data center construction. Florida Governor Ron DeSantis, who's on the complete opposite side politically, is saying similar things. When the far left and far right agree something's a problem, that's usually a sign everyone's mad. With midterm elections coming in November 2026, this becomes a political weapon, not just a business issue. Regular communities are fighting back too. In Palm Beach County, locals opposed a proposed data center because of noise, water usage, pollution, and higher utility bills. One resident said nothing good comes from having an AI data center near you. This kind of local opposition makes getting permits and building stuff much harder. Now let's examine how the AI industry actually works, because this shows another weak spot. Industry analysis shows about 80% of companies calling themselves AI companies are just reselling access to a few big models, mainly OpenAI's GPT, Anthropic's Claude, or similar services. They're building basic apps on top of someone else's technology? This could work if those apps created real unique value, but many face tough economics. It often costs them more to get a customer than that customer is worth. They're competing on features that others can copy quickly, and they depend on whose prices they can't control. When OpenAI or Anthropic decides to change prices, add competing features, or modify their terms, these smaller companies can't do anything about it. Their competitive advantage is often paper-thin. This creates a pyramid setup. A few foundation model companies at the top with massive funding and partnerships, thousands of application companies in the middle, many won't survive long-term competition, and users at the bottom still figuring out what's actually worth paying for. Venture capital money patterns make this concern worse. In 2025, AI startups grabbed a huge chunk of all VC investment. Some estimates say over 50% of all venture capital went into AI companies. That's not spreading risk. That's putting all eggs in one basket. History proves that when VC funding concentrates this heavily in one sector, it's usually a sign we're late to the party. The best opportunities probably already got funded. The companies getting money now are filling small niches, making tiny improvements, or copying what already exists with minor tweaks. Money isn't being used as efficiently. Later stage AI companies often need billions in funding just to compete. That's completely different from the lean startup approach that defined earlier tech waves. When you need billions just to play the game, only people with access to huge money can enter, and ways to exit narrow down. On regulations, trouble is brewing. The European Union's AI Act creates complicated rules companies must follow. In the United States, we don't have comprehensive federal rules yet, but lots of bills are floating around. States are making their own regulations. And election interference worries are pushing both parties towards some kind of AI oversight. These regulations might be needed and good, but they also create uncertainty, increase costs, and can blindside companies that built products assuming they could do whatever they wanted. Then there's the talent problem. AI engineer salaries have hit levels that can't last. Pay packages for experienced machine learning engineers at top companies can exceed $500,000 to $1 million per year. That's roughly 3 times what was normal in previous tech booms. These salary levels make sense when companies have unlimited money and are fighting desperately for rare talent. They make zero sense when revenue growth slows, funding dries up, or investors start demanding profits instead of growth at any cost. Salaries usually come back down to earth eventually, and when they do, it's messy. Insider selling patterns tell another story. Throughout 2025, executives at major AI companies sold tons of their own stock. When founders and early employees sell big positions, it doesn't automatically mean disaster. They have legitimate reasons to diversify or fund other projects. But selling a lot while publicly saying everything's amazing creates a weird contradiction worth noting. So let's step back and look at everything together. We've got valuations assuming explosive growth. We've got infrastructure spending racing ahead of actual revenue. We've got productivity gains that remain small despite everyone using AI. We've got energy problems that could physically limit growth. We've got a thin layer of apps depending on a few foundation companies. We've got regulatory uncertainty. We've got unsustainable salary costs. And we've got both political parties opposing the infrastructure impacts. No single one of these things proves a bubble exists. But altogether, they suggest the AI industry is heading toward a moment where dreams and reality need to meet. Now, here's the important part. This doesn't mean AI technology will fail. Railway companies failed, but trains changed transportation forever. .com companies failed, but the internet changed absolutely everything. AI will almost certainly transform knowledge work, automation, decision-making, and countless areas we can't even imagine yet. The question isn't if AI succeeds. It's whether today's valuations correctly price the timeline, how fast people adopt it, competitive forces, and whether the economics actually work. It's whether investors buying today at 40 to 70 times revenue will actually make money that justifies those prices. It's whether all this infrastructure being built will generate enough revenue before cheaper options appear or efficiency improvements make parts of it unnecessary. If AI adoption speeds up faster than current rollout, if breakthrough applications emerge that justify premium prices, if productivity gains show up at massive scale in the next 12 to 18 months, then today's valuations might look brilliant. Markets sometimes correctly predict transformational change before everyone sees it. But if adoption happens more gradually, if productivity gains stay small, if energy problems become limiting factors, if regulatory costs increase, if competition drives down profit margins, then a crash becomes likely and not in 5 years. Current spending rates, debt levels, and political pressures suggest any crash would happen much sooner, probably in 18 to 24 months. That timeline is driven by specific triggers coming up. The infrastructure debt borrowed in 2025 will start demanding proven returns. Midterm elections in November 2026 could create political pressure to slow data center expansion. Companies that raised massive funding in 2024 and 2025 will need to show they're moving toward profitability. Public markets will demand proof that all this capital spending pays off. And energy grid problems could force physical limits no matter how much money people want to spend. The smartest analysts aren't saying AI is bad. They're asking tougher questions about valuations, timelines, and whether this is sustainable. They're separating companies with real competitive advantages from those just reselling commodity services. They're watching actual productivity data, not just who's using AI. They're monitoring debt levels, not just revenue growth. For investors, the lesson from railway mania and the dot-com crash isn't to avoid revolutionary technology. It's to be extremely careful about paying for revolution before it actually happens. Railways succeeded. Railway investors mostly got destroyed. The internet succeeded. Dot-com investors mostly lost everything. I will succeed. Whether AI investors succeed depends completely on the price they're paying today for tomorrow's transformation. And right now, looking at all the valuation metrics, spending patterns, productivity data, infrastructure limits, and regulatory pressures together, the price looks dangerously high. The tension is building. The question isn't if something breaks. The question is when and how bad it's going to be.